Rhinomed's shares have surged 9.62% to reach 0.285 Australian dollars as of today at noon. As usual, we have found a few ASX penny stocks which aren't getting impacted by the market's fall.
Has it ever occurred to you that penny stocks can make you as rich as any other high-valued stocks? When people think about trading stocks, they immediately think about shares of industry giants like Apple, Amazon, and Google. But what you may not know is that trading doesn't necessarily require millions of dollars for the biggest company names in the stock market. That's where penny stocks come in. Penny stocks, occasionally referred to as micro-cap or nano-cap stocks, are low-value stocks representing smaller companies. As the name suggests, these stocks are often priced under $5 per share, making them much more accessible to new investors or those with less capital. Because these stocks are so cheap, it's nearly risk-free to try your hand at penny stock investing. But identifying the best ones is where the challenge lies. Lucky for you, we've done a thorough research and came up with a list of 5 unknown penny stocks you can invest in and expect unimaginable growth over time. You'll be surprised at how good these stocks are and the great potential they hold. But before we get down to that, tell us, would you rather invest in penny stocks or common stocks? Let us know in the comments below. Now let's get it on. Many investors are taking penny stocks seriously. While other industries are lagging behind, some stocks in the niche show positive signs that are turning investors' heads. Since the penny stocks niche is appearing to show positive signs, investors are gunning for the ones that will weather the storms and the test of time. Here are some top penny stocks to watch. Number 1. Salem Media Group, SALM. Salem Media is America's leading Christian broadcaster. It currently trades at around $3.04 and possesses a market capitalization of $88 million, putting it squarely in the microcap territory. The company owns and operates more than 115 radio stations, including over 70 in the country's top 25 media markets. Salem Media's other businesses include Christian and conservative websites. It even provides financial advice through Eagle Financial Publications. In the company's Q3 2021 results, it reported sales of $66 million, 8.8% higher than a year earlier. On the bottom line, Salem has adjusted earnings before interest, taxes, depreciation, and amortization of $10.83 million, 12.5% higher than Q3 of 2020. An interesting line item in the balance sheet is its property and equipment assets. At the end of September 2021, they were carried on the books at $78.4 million. Its land holdings accounted for $27 million, or 34% of its property and equipment assets. On July 23, 2021, Salem sold 34 acres of land in Lewisville, Texas for $12.1 million cash. It generated a pre-tax gain of $10.5 million on the sale. It retained a small sliver of the property to keep radio station KSKY-AM from moving. On August 31, 2021, it agreed to sell 77 acres in Tampa, Florida for $13.5 million. That's $25.6 million in proceeds, which works out to 94 cents a share, or 29% of its share price. Assuming the remaining $27 million in land holdings sell for double that amount, we're talking about pre-tax gains of $27 million, or almost $1 per share. The company was founded by brothers-in-law Stuart Epperson and Edward G. Stinger III, and unlike many Christian broadcasters, is a for-profit corporation. This allows it to buy stations in the commercial radio band, which are often higher powered than those of the FM non-commercial band, and accept commercial advertising. These appetizing statistics therefore make Salem Media Group stocks worth your investment. Number 2. ObsEva, OBSV. ObsEva produces therapeutics targeted at women's reproductive health. There are 2 primary reasons to consider investing in OBSV stock for 2022. First, let's take a look at the fundamental business. It's not particularly risky like other biotechs and penny stocks. This is because its most recent earnings report indicates a strong position. First of all, ObsEva reported a net gain of $800,000 for the quarter that ended September 30th. That was a significant turnaround from a year earlier when it posted a $24.4 million loss. Secondly, the company's cash position is far better than it was at the beginning of 2021. On September 30th, ObsEva reported a cash position of $62.9 million, up from $31.2 million at the end of 2020. On top of those fundamental reasons, there's another positive factor behind ObsEva. That is, it was recently added to the NASDAQ Biotechnology Index. CEO Brian O'Callaghan noted, "Being a part of this index enables us to reach new audiences, and I look forward to this exciting next chapter as we continue to grow, bring innovation to the field of women's health, and build on our success to date." Through strategic in-licensing and disciplined drug development, ObsEva has established a late-stage clinical pipeline with development programs focusing on treating endometriosis, uterine fibroids, preterm labor, and improving ART outcomes. Number 3. Charles & Colvard, CTHR. Charles & Colvard Limited operates as a fine jewelry company in the United States and internationally. The company manufactures, markets, and distributes moissanite jewels and finished moissanite jewelry under the Charles & Colvard created moissanite brand, and premium moissanite gemstones under the Forever One brand name. It also markets and distributes lab-grown diamonds and finished jewelry with the lab-grown diamonds under the Cadia brand. The company sells its products at wholesale prices to distributors, manufacturers, retailers, and designers, and to end consumers at retail prices through charlesandcolvard.com, third-party online marketplaces, dropship, and other e-commerce outlets. The company was founded in 1995 and is headquartered in Morrisville, North Carolina. In 2020, Charles & Colvard announced that it would get into the diamond market with the launch of Cadia, a premium brand of lab-grown diamonds. A few highlights from its Q1 2022 results include a 30% increase year-over-year in revenue to $10.3 million, a 20% increase in online sales, and an 8.6% increase in operating profits. It had no debt and $19.2 million in cash, cash equivalents, and restricted cash as of September 30, 2021. The company's trailing 12-month free cash flow through the end of the first quarter is $4.2 million, and its free cash flow yield is 5.5%. Experts consider anything yielding between 4 to 8% to be delivering growth at a reasonable price. In late September 2021, the company announced it would build its first Charles & Colvard signature showroom at its head office in North Carolina. The move allows it to showcase its signature collection, Cadia lab-grown diamonds, and its other premium jewelry. Up significantly from its March 2020 lows, Charles & Colvard's late 2021 swoon provides investors with an opportunity to buy on the dip. Number 4. Predictive Oncology, POAI. Predictive Oncology Incorporated provides various healthcare products and services primarily in the United States. The company operates in 3 segments: Holomics, Soluble, and Skyline. It manufactures environmentally conscious systems to collect and dispose of infectious fluids that result from surgical procedures and post-operative care. It offers Streamway System, a wall-mounted, fully automated system that disposes of the suction fluid, providing uninterrupted performance for physicians while virtually eliminating healthcare workers' exposure to infectious fluids collected during surgical and other patient proceedings, as well as proprietary cleaning fluid and filters to users of its systems. The company also provides contract research organization and AI-driven predictive models of tumor drug response to improve clinical outcomes to assist pharmaceutical, diagnostic, and biotech industries, and soluble and stable formations for proteins, including vaccines, antibodies, and other protein therapeutics, as well as develops tumor models for precision cancer therapy and drug development. It's based in Eagan, Minnesota. Predictive Oncology is a firm that has awarded investors over 2021. Year to date, Predictive Oncology stock was up modestly to nearly $1 after beginning 2021 at 72 cents per share. Price increases of 38% aren't exactly modest, so to speak, but we're talking about penny stocks here. However, the company's stock already spiked early in 2021, rising to $2.20, which is why I call its overall 2021 performance modest. Fundamentally speaking, Predictive Oncology is not a bad company. Per its most recent earnings report, the firm has no outstanding debt and a cash position of $41 million. That's significantly higher than the $2.3 million in cash it reported a year prior. That makes its shares suitable for any willing investors who don't have to necessarily splash tens or hundreds of thousands of dollars. Number 5. WidePoint Corp, WYY. WidePoint provides trusted mobility management solutions, such as identity and access management, consulting, secure holding solutions, and multi-factor authentication. primarily to the federal government, as well as state and local governments and commercial enterprises. These organizations hire the company to ensure their employees' mobile devices are secure. It currently trades at around $3.88 and possesses a market capitalization of $36 million. Its stock has been down 69% over the past 52 weeks. A major reason for the company's stock losing altitude over the past year has to do with its 2020 census project with the U.S. Department of Commerce ending. For example, its carrier services revenue through the first 3 quarters of 2021 fell 69% to $36.3 million, from $118.1 million a year earlier. Meanwhile, its managed services revenue also declined in the period by 26% to $26.5 million. Overall revenue fell 59% to $62.9 million. However, despite the steep decline in year-over-year revenue, its operating income through the third quarter was still positive at $1.4 million, 44% less than a year earlier. A big reason for hanging in there has to do with a 940 basis point increase in its gross margin. With no debt, $18 million in cash, 95% recurring revenue, and 17 consecutive quarters of positive earnings before interest, taxes, depreciation, and amortization, the chances are good that WidePoint will work itself out of its current funk. Under $4, this is one of the penny stocks that could be a steal for sure. And that's it from us today. We'll be following up on these stocks to show you the progress in our upcoming videos, so stay tuned. Which of the above penny stocks we've covered would you invest in? Let us know in the comments below.